Guys, I've managed to make over $40,000 in just 1 week alone in November. And by applying this one simple concept into my trading system, I'm able to increase my win rate by at least 10 to 20%. And regardless if you're a day trader, swing trader, or position trader, you can also apply this concept into your trading strategy and system in order to make more money in the markets. So without further ado, let's dive right in. So by the end of today's video, I'm going to explain to you how these two processes actually help me to identify a low risk, high reward entries, and also to identify very strong trending stocks so that you can actually avoid being chopped out or faked out. Because a lot of time people enter a stock, they often wonder whether the stock is going to go to their favor or actually chop them out of their stop loss. So there will be no more confusion from your side and no more overthinking. Just a clear two-step process to help you identify exactly when and when not to enter a stock. One of the most common questions I get from traders is that they ask me, Valen, I traded so well for the last week, but I lost all my profits in one single day. And that gave them a lot of headache. And one of the reasons for that is because they fail to understand that the market exists in two different conditions. The first condition is actually a trending market, and the second condition is a choppy market. To fully understand these two market conditions, let us define what is a trending market. So the definition of a trending market is that there's always a higher high and a higher low. Higher high, higher low, higher high. So the market is always going upwards. In this case, we call this a trending bullish market. And for a bearish market, it's simply the opposite of that, which is there is a high, there's a lower high, lower low, lower high, lower low. So in these two examples, you can see there's a very obvious trending market because the highs and lows are always different. So you can see in the choppy market, the highs and the lows are actually always equal, which suggests that the market is going nowhere but sideways actions. So it's actually very important to understand these two market conditions, which is the trending market and the choppy market, because understanding these two market conditions will actually significantly improve our edge in the market as well. And I'm going to explain to you how. You see, there's this term called the statistical advantage because your trading system is only suitable for certain conditions, but not all conditions. You know, often in our daily lives, we are always taught to do more because do more equals more results. But this is counterintuitive in trading because in trading, it's not always about doing more because doing more doesn't mean more profits. However, doing the right thing will actually make you more profits. And the reason for that is also because not all 12 months actually have the same market conditions. Because some months, they do have a trending market, and in some months, it's only very, very choppy, which doesn't bring us anywhere. So you can see that in 2025, in 12 trading months, only 60% of it is actually a trending month, which means we only get 7 months of trending markets. And 40% of those is actually choppy months, which means there's around 5 months that the market is not going anywhere but sideways. So you can see that 90% of my profits actually only come from the 7 months of trending markets, and less than 10% actually comes from the sideways action. So the probability of making a lot of money is actually from these 7 months. So we only want to focus on these 7 months because these 7 months actually have a very high probability of our trade and our trading system actually playing out. And risking a lot of money in this choppy 5 months actually is not an ideal system. So you guys have to always understand and remember that the trend is always your friend. So you want to trade along with the trend because a trending market is what pays us the most. So another example I'm going to show you is the S&P 500 seasonality report. So we always refer to S&P 500 as the market. And you can see the market is not usually trending every single month. So you can see that the first quarter of the year from January to March is usually very choppy for the market. So this is what we call a very low probability market condition for our trade to actually play out. Whereas April, you can see that the market is usually very strong seasonality wise. There is always a higher low, higher high, higher low, higher high. And it's very obvious that the market is actually trending higher. So in these kind of specific month, we want to always trade more aggressively. I also want to let you guys know that seasonality doesn't necessarily reflect the actual conditions in the market, but it does give us a reference on whether the market is actually stronger on that specific month or weaker based on seasonality. So you guys can see that even in a bullish market, not every month is actually a trending month. And we only want to trade a trending month because a trending month will generate us a lot of money. And that is also why timing is everything. You only want to be super aggressive in trending months and you'll be defensive in choppy months like that to actually protect your profits. So which day is actually easier to trade in your opinion? Is it market A or market B? So you can see that in example A, the market overall is quite choppy because there are actually equal highs and there are actually equal lows. So in this kind of market conditions is what we call a low probability market condition. And if you plot in our trading system, you guys know that I always trade the momentum breakout strategy. If you want to know more about the strategy, I've put a link down in the description below. You can click that to know my full strategy on how do I actually trade momentum breakouts. But you can see that after we apply our strategy, the probability of it actually making money is not that high. So you can see that even though the first trade we actually managed to make $4,300, the stock price didn't actually went down. It reversed all the way back up to our stop loss, which suggests that the trend is actually not as weak as what we expected when we took a short position right here. And when we entered the second trade for a long position, we're actually being chopped out of our stop loss, and then it went all the way down. And we lost another $2,500 on our third trade when the market went all the way up and chopped us out. So you can see that in these market conditions where it's very choppy, the probability of our system actually playing out is actually very low. Whereas in example B, you can see there's a very obvious high, a higher low, a higher high, higher low, higher high, higher low, higher high. So we always want to trade market conditions that are always trending. So we can obviously see that this market in example B is actually a trending market. And if we apply our system, you can see it's very obvious that if we took a long position right here, we actually made $3,500. And we also made money in the second and the third trade. So you can see that even you entered a very bad position, let's say you managed to enter the price right here, and because you trade with the major trend, you still manage to make money from this. And the reason for that is because in a trending market, if you follow the big waves, even you get a very bad entry, you will still make money. So always remember that the trend is your friend. So there are only two methods to identify a trend, and it's very, very simple. So I already reviewed the first method, which is the price action method. And to identify an uptrend, you always want to have a higher high and higher low. So that's how we identify an uptrend. And in a downtrend, we always want to have a lower high, a lower low, a lower high, lower low. So it's very straightforward. And if you're still having a hard time to identify price action, I actually have an indicator that can help you to identify it visually. And I'll show you in the later examples. So the second method is actually using the indicator method, which is one of my favorite methods as well because it helps me identify immediately whether a trend is in an uptrend or a downtrend. So you simply want to plot the simple moving averages for 10 days and 20 days on a daily time frame. And you can see in this example, you always want the SMA 10 to be above the SMA 20 to be in an uptrend. What it simply means is that the past 10 days average price is actually higher than the past 20 days average price. So in this example, you can see that the red line is actually the SMA 10 and the blue line is actually the SMA 20. And as long as the SMA 10 is actually above the SMA 20, we can say that this is actually in an uptrend. So now we are actually in our trading view. I want you to go to the top bar and click on the indicator. And once that pops out, I want you to key in moving average ribbon. So you can see that moving average ribbon actually pop out. I want you to click on that. And what that gives you is actually all the SMAs. So you want to go to the top left corner, click on settings. I want to untick the bottom two moving averages because we only need two SMAs. So you want to change the first one to 10 and the second one to 20. I'll change the color for the first one to be red and the second one to be blue so you can understand it better. So the second thing I'm going to do, I'm going to go to the time frame. I'm going to change from chart to 1 day. And the reason for that is because we only trade on the 1 hour time frame, but we want to look at the MA for the daily time frame. So once you click OK, it will pop out two lines that shows you exactly what we've shown you in the example just now. After you plot in the moving averages, you can see that the SMA 10, which is the red line, is actually below the SMA 20, which suggests that the market is actually on a downtrend. So you can see for the price action method, you can see there's a very obvious high, a very obvious low, and a lower high and a lower low. We can know that this is actually on the downtrend as well by just looking at the price action. And if you're having a hard time to identify a lower high and lower low, I'm going to show you another indicator that I use that can help you to easily identify as well. So all you got to do is go into the indicator section and type in pivot points high and low. So you can see that in this first one, pivot point high and low, click on it. And essentially what that shows you is that it shows you all the swing high and swing low. So you can see the price always are going downwards. And you can see that this is a swing low, this is a swing high, and this is a swing low. So essentially what this does, it helps you identify the swing highs and swing lows. So if you're having a hard time to read the price action, this indicator actually helps a lot. So we identified that Toast is actually on the downtrend and we only want to take a short position in a downtrend. And after Toast actually broke out from our trend line, we're actually going to enter a short position. So we're risking $2,500 in order to make $5,000, and let's see how that plays out. So you can see that we have made $4,800 just from this simple concept of following the trend. So even if you enter a short position at a very bad entry, you will still take profits because the trend is always your friend and the trend will always drive the price towards the direction that it's going. So the next stock we're going to talk about is actually CRM. And CRM is another stock that we've taken in live trades and we have lost $2,500 on this trade, and I'm going to explain to you why. So you guys can see that after we plot in the MAs, you can see that the MAs are crossing over each other all the time. And these simply suggest that the market is in a choppy condition. And if we want to use the price action method to identify whether we are in a choppy condition or in a trending market, we can see that the highs are almost at equal sides and also the lows are almost equal as well. So this simply suggests that this is a very choppy market condition and is a low probability setup. So after the price actually broke out from our trend line, we took a short position and we're risking $2,500 in order to make $5,000. So let's see how that plays out. So you can see the price initially went to our favor, but there is no continuation in this market because it's a choppy and sideways market. And it went all the way back up to hit our stop loss, resulting us to lose $2,500 in this trade. So the third trade that I took is actually RVMD. And you can see RVMD, we managed to make around $5,000. And let's dissect the RVMD's market condition. By looking just on the MAs, you can see that the red line is actually above the blue line, which suggests that we are actually in the bullish uptrend market. And secondly, if we look at the price action, there is a high, there is a low, there is a higher high, higher low, higher high, higher low. So we can confirm that we are actually in an uptrend. So taking a long positions will be a high probability setup as well. So you can see that after RVMD broke out from our trend line, we want to enter a long position and we're risking $2,500 in order to make $5,000. So you can see in a matter of 8 days, we managed to make $5,000 of only trading along with the trend. So I want you to apply this simple concept into your trading system of basically understanding where is the trend and always trade alongside with it so you can make more money in the markets. So if this video helped you in the slightest way possible, please leave me a comment down below. Like, subscribe to the channel because I do post video every Wednesday as well. And I'll see you guys in the next one. Peace out, guys.